This is Jeff Adler, and I'm here at the National Multifamily Housing Council Fall Board meeting. And we're here with Andy Buchanan and Doug Root, who just founded a new company called Blackfin. Hey guys, help me understand where the name Blackfin Real Estate Investors came from.
I'll let you take that one.
Yeah, so really, came out of, I'm a huge fisherman,
Okay.
and, just trying to tie in a little passion for my fishing addiction. And Andy was kind enough to go along with it. I thought it was a cool name, so
Okay.
that's how we arrived at it.
All right, great. So from what I understand, your focus is multifamily investments with a focus on the value-added opportunities along the eastern seaboard. Is that a fair assessment?
Yeah.
And could help me understand kind of how you arrived at that focus and what it means to you guys.
Yeah. Well, I think, from, I worked at a development and acquisition company, and I think at this time in the cycle, I feel, investing my own money, investing investors' money, I think there's more opportunity from a risk-adjusted basis to go after value add.
Mm-hmm.
The development cycle is sort of at the end in a lot of places. It'd be hard to start up a new development company today. And I think that the best opportunities for our investors and for ourselves are in the value add space.
I mean, there has been a lot of discussion around quality workforce housing. I don't really want to use the term Class B because some of that accommodates it's not A, but that's not really true in that context. When you think about your geographic target area, are there any particular city markets that kind of call out to you as, wow, these are really great places to be?
We're focused on Boston through the Carolinas, and we're obviously trying to stick to the markets that have the best job growth.
Yeah.
And so we like northern New Jersey submarkets. We like Boston and suburban Boston. We like some of the markets in the southeast, like Charlotte and Greenville, South Carolina, Charleston. We're seeing a lot of job growth.
I mean, so there's a big difference between the job growth numbers that we're seeing, let's say, in the southeastern part of that, the geographic zone, versus the northeastern part. Is that meaningful to you guys?
I think it helps in our submarket discussion, and we're looking for the submarkets in the Northeast where the jobs are being formed. They're not being formed in droves, but they're also usually higher earning type of jobs. And we look to those submarkets in the Northeast, and then in the Southeast, you're just trying to find the right market, and then there's submarket discussions.
So when you discuss submarkets or markets or places where you want to be, are there particular variables that you kind of latch on to or say, this is the kind of place, or you can give me even some examples of these are the kinds of places where we think outsized opportunities exist?
Absolutely. And a lot of it, I'd say, in addition to we're focused on the variables of the submarkets that we like, and we've already kind of pre-screened markets that we consider to be, investable, where we want to, put capital. But we're really then kind of feeling back with what's driving a lot of the next decision is the actual opportunity, right?
Sure.
And where we think we can outperform the market and what the drivers within those individual deals, and that's where when you get into this value add strategy, it's like how many of the value add kind of variables can we control?
Yeah.
We can actually create the value versus relying strictly on the market providing the yield enhancement.
Yeah.
And so we're trying to improve operations. We're trying to buy from owners who are probably less sophisticated, don't implement revenue management strategies, who are just kind of managing for cash flow and having pushed.
Do you think there's still a lot out there? I mean, the sector's become increasingly institutional, professional, but do you think there's still opportunities like that?
Absolutely. It's always the question that we get, but we continue to surface more and more opportunities. We have a busy week this week of looking at several opportunities that have kind of surfaced in that domain that have those kind of unsophisticated ownership structures that we think we can benefit from.
So some of the work that we've done, we kind of look at what we call them intellectual capital nodes. So it's places where there is a concentration of thought work, let's put it that way. Could be different industries, could be biotechnology one place, it could be robotics another, it could be software somewhere else, or it could be healthcare. But the commonality is that there's sort of this node of thought work happening where proximity and location matters, and that doesn't necessarily have to be in a downtown. It could often, it's in suburban centers but they're sort of within a 3-mile ring of where the university or set of locations are. And so that's how we think about these places up and down, actually throughout the United States. And so, we look at places, I think, somewhat similar in terms of Charlotte being great. I don't know if you went over to see the NBC political side of it. They were talking about how North Carolina is a changed state, and we definitely would agree with that. When you look at the kind of opportunities that you guys are trying to find, is there a particular strike zone in terms of either unit size or capital that you're trying to place, in terms of dollar size? And is there a particular vintage of age of the asset you're trying to look for? Are there certain things that turn you on or turn you off? Just to help, everyone understand kind of what your strike zone is.
I think, we like the 15 to $50 million marketplace. We think that's a little bit less. Every market's very competitive. These days it's slightly less competitive than, if you're going for a $70 to $100 million deal.
Right.
Doesn't mean, some of our capital partners that we're talking to will, they'll stretch and they'll buy $1 billion.
Sure.
It doesn't, it's not going to happen for us anytime soon. But, it varies. But we think the best opportunities are in the $15 to $50 million range based on and the vintage that we're looking for, which isn't really this 80s and 90s type
80s,
of
90s vintage.
Yeah, and I think it depends on market, right? So if you go into some of the more mature markets, as you get up into like the northeastern markets, the housing stock, traditionally, and some of these, private owners, they've held for a long time.
Right.
A lot of deferred maintenance. They've injected new capital. We feel like bring new capital into those older deals. We buy a 60s, 70s vintage, asset in a suburban, New York, New Jersey metro, or suburban Boston location. Whereas that housing, stock in the Carolinas, probably less of it, probably less attractive to us. We kind of put that more in like the C category. Probably not, going to be the space that we play in. I think capital partners are less excited about that product quality in the newer housing markets.
Gotcha. Okay.
They could get a better quality of asset.
So, along those same lines, what kind of investors are you guys working with, and which investor groups seem to be most interested in the kind of strategy you're pursuing?
So we got a mix of institutions, high net worths, family offices, private capital, and I think for us, and one of the things that's probably a little bit unique from is especially working with the institutions. Not a lot of, obviously clearly some guys with our experience have stepped down from roles, senior roles in organizations, but we've come from highly institutional backgrounds. We've kind of been in the trenches with a lot of the capital relationships, so they kind of have maybe a little bit like, I don't know, we get a warmer reception, when we're talking about deals, because we're all speaking the same language, and we know their process really well, because we've been in those processes before, and can provide them, exactly what they need.
Now, you think of when you do land a deal, you third-party manage, outsource your management for a little while?
Yeah, right now we're not vertically integrated. We will. That's one of our goals to become that. But we like that strategy in that we can find the best third-party manager for the asset. We're not tied to one company or market in that case, and we can find the best one for the asset and in the market that it is, the vintage that it.
There's two versions of value add. One version is probably more of a $10,000 to $15,000 kind of light kind of touch up, and the other one is a very deep, $40,000 to $50,000 unit kind of play, where you're really taking a much older asset and trying to move it up. Do you guys have a preference for which one you think works for you guys, or which one is more available right now?
I think we really like the deep value add, where there's a lot of tuning. I think those deals are hard to come by.
Yeah.
We actually are working on one right now where we're in that kind of $50,000 a unit, like overall capital repositioning.
Right.
And so, we really like those deals. We just think it'll be more, the larger part of our portfolio is going to look and feel like a $10,000 to $15,000 like overall renovation per unit.
Another kind of question I have is for you guys, if you have an opinion on this. Are washer and dryers a break point for you? Washer and dryer in unit, I should say. Are they a break point for you? They define one type of asset versus another type of asset.
That's a tough question.
Okay.
Well, I think it does, but it's all again market dependent.
Okay.
Right? I mean, you get an urban infill New York metro, opportunity without a washer dryer. It's not the end of the world, right?
Right.
It's more commonplace. You start to play in suburban markets, and you're the only one without
Then you're
a And I think from a capital standpoint, I think our capital relationships really see that as a deficiency. An asset. It's an asset defect in many cases, right? And it's going to have less liquidity. Buyer pool's thinner. So I think we do we make exceptions. But I'd say it would be less desirable.
Yeah, I mean, so in my kind of experience, that was one of those kind of chief kind of breakpoints. Was if you had a washer dryer connection in the unit, you could play right, in an upper end. You had more opportunity, but if you didn't, unless you were truly downtown urban infill, it was never going to ever be a B-class asset ever.
You're always going to be trading at a discount,
right?
The comp set, and we see that as a deficiency.
So you guys have both been in the industry a long time, and you've been through a bunch of cycles. Where do you think? Where do you think? Well, I'm older than this. Where do you think we're at in terms of a lot of our investors ask, so which inning are we in? Which are we in a doubleheader? Or is it the eighth inning, seventh inning? So how do you think about that in terms of you guys are starting out and looking for a 7 to 10 year investable horizon? Where do you see this right now?
I'll let Andy take it since he's older and seen more cycles.
That's true. I think we are in the value add space. I like baseball. I wouldn't give it an inning reference, but I think the bigger picture there, and the reason why people are flocking to this investment type is that the product that we're looking at doing value add is not being created by developers today.
Sure, you can't do it in construction.
Right.
What kind of rents are you kind of targeting on a monthly basis?
Well, that depends.
$1,200, $1,300, $1,400 a month kind of number?
Around
when you're done?
Yeah.
On average.
Okay, sure. But different than the $1,800, $2,000, $2,500 a month typical kind of Class A new construction type.
Correct. So we feel that as long as they're not building a new product and we're buying assets, one of the bigger metrics that we're looking at is that we're buying it below replacement cost.
Sure.
That the demand is going to continue to grow and there will be the supply. So there are certainly things that we have to be cognizant of, and certainly things that could hurt the overall investment thesis. But the long-term idea is that with a limited supply and growing demand, you should be able to move rents in a stable market.
Yeah, one of the reasons we like it too, right? We're kind of in a yield constrained, capital markets, right? And what multifamily provides you is a strong risk-adjusted yield, right? And I think that's why, capital likes it. We feel like, we've got a lot of relationships with family offices, high net worths that want exposure to the asset class, and we can provide that yield opportunity.
So if folks wanted to get in touch with you, how do they do that?
Yeah, go to blackfinrei.com.
Okay.
Yeah. All of our contact information is right there.
Even our phone number, so you can give us a call.
Anything kind of closing comments about what what kind of philosophy you have, what kind of mission statement, or kind of what do you want? Let's say we're having this conversation 5 or 7 years from now. What would you like to be known for?
I think it's pretty easy. I think we want to be kind of best in class owners and operators, kind of deliver what do what we say we're going to do, and treat our team and all of our investors in a way that continue to do business together for a really long time. And that's our goal, is to have great relationships. We're relationship guys. We like people. We want to partner with good partners and build a fun working environment and do a lot of deals and hopefully provide people
and go fishing.
Yeah, we can maybe get to go fishing again. Right now, it doesn't seem like I'm ever going to go fishing again. But
all right. Well, thanks a lot. It's been a pleasure talking with you guys, and I wish you the best of luck.
Thank you.
Great. Thank you.